Hi, everyone. Welcome back to the Functional Retirement Podcast. I'm your host, Thatcher Taylor, certified financial planner and owner of ProPath Financial. And since we talk a lot about retirement at my firm, we get into taxes often. Now, the tax code is built. There's a bunch of really smart people back at the IRS and, I shouldn't say smart people at Congress, but you know what I mean. There are people at Congress that build out these tax rules that we have to abide by. But how does it relate to retirement? Remember, you want to try to save the most in taxes throughout the remainder of your lifetime, not just in any given year. Too often, people focus on any given year and forget about the subsequent years throughout the rest of your life. And the tax code is thought through this because if you try to save too much now, you will end up paying later. Or if you pay too much now, you didn't get the opportunity to maybe protect some of it later. So it's the reduction of taxes throughout your lifetime. So in theory, the whole point of this saving and investing journey, this accumulation journey, is that we get to retirement, we get the ability to spend down that money and enjoy it. That's the whole point. In practice, a growing base of research finds that for most of their retirement, or for most people in their retirement, retirees just continue to grow their portfolios, which essentially means they get to retirement. And a lot of people come to me, I don't want this portfolio value to decrease at all. I only want to spend a little bit where the portfolio will not decrease, or maybe I just want some interest or dividends or whatever. So you don't want the portfolio value to decrease. That creates what's called a consumption gap between what retirees could and potentially should spend versus what they actually do. There's a difference. The reality is that for long-term retirement, where compounding inflation can double or even quadruple, spending needs after 30 years, which after 30 years, our portfolio doubles or triples. I mean, there's a lot of things that can come into play. Retirees actually should allow their portfolios to grow at least slightly for the first half of retirement. And just in case it's a necessity to cover big expenses later in retirement. The reason I tell you all this is because I believe a lot of these spending avoidances are tax related. People become scared of paying more in taxes because a lot of the places that the money comes from creates a taxable event. You know, that coupled with the fear of not having enough and having a life built with really good behaviors. Usually people with a lot of accumulation have reasonably good behaviors. But when it really starts to combat, or when taxes start to come into play, people start to get very concerned. Oh, I need an extra $10,000. That's going to cost me an extra $2,500 in taxes. Yeah, we're not going to do that. We'll leave the account the way that it is. So I believe with the proper planning and implementation, you can spend, pay just the right amount of taxation, and enjoy the heck out of your life without worry. So it's just about spending the right amount of your assets and managing the taxes along the way. There's going to be obviously a screen share to this. So if you want to go check this out on YouTube, you can see this podcast now on YouTube. You'll see the link below. You can also go to propathfinancial.com/posts/tax planning to be able to read the full supplementary blog article. You can even watch it there as well. So the first place we need to go are tax brackets. All right, so the next place we need to start are tax brackets. Our tax system is a graduated system. It has different brackets. Every dollar that you earn is taxed in a very specific bracket. If you made $1 million a year, the first $23,000 of it is taxed at 10%. If you made $23,000 a year, that's all taxed at 10%. So the brackets are graduating. You can see my screen here. If you're not looking, you can check this out on YouTube. You can also download this chart if you want to. The link below will be in the show notes or in the comments section. But you can see the tax brackets are 10, 12, 22, 24, 32, 35, and 37. And let's just focus on married filing jointly. There are ranges within each one of these brackets. Let's say you made $201,000. Any dollar above there is in the 24% tax bracket. But below that, there are ranges for 22, 12, and 10%. So as you make more money, the next dollar could be in the same or taxed at the next highest bracket, but all the previous dollars are in the same brackets for everybody. So from $94,000 to $201,000, that's a 22% tax range. This is very important to understand because as we dig into retirement and we start to distribute your assets, we start to think through, where is the next dollar going to fall? In what bracket is it going to be charged at? That makes a big difference. The 22% bracket's a big one. It's $94,000 on the bottom end and $201,000 on the top end. This is a very common bracket that retirees are going to fall into as they start to distribute more because they're getting maybe IRA dollars or they're getting dividends and income from a trust or joint account. And then they have potentially Social Security coming in. So that's a big one. So now that we understand these tax brackets, we know now that there's no separate retirement tax brackets. These tax brackets are the retirement tax brackets as well. There's no way to switch them up or change them once you get to retirement. One thing I want to clarify is your effective tax rate. Your federal effective tax rate is the total percentage of the income you pay in federal tax, calculated by dividing what you owe by your total income. This is essentially line 9 of your 1040. That's your total income. Line 9 on your 2023 1040. And then you go to the next page, you look at what in taxes you paid. You take those numbers, you divide them, and that comes out with a percentage. That percentage is usually some obscure percentage that may not be directly correlated to the tax brackets. Because of the graduated system, not everything is taxed at 22%. Only a portion in that bracket. So what you actually pay is most likely less in an effective tax rate from what you paid at your highest marginal bracket where your next dollar was taxed. So what most people say is, man, I paid 37% last year. I was in the highest tax bracket. That's for only money that was paid over $731,000 that was taxed at the 37% if you were married filing jointly. Now, you do pay higher tax rates in general because there could be your Social Security tax if you're still working. There could be some state tax and some additional tax where if you have high income, you may have a net investment income tax. So there's some other elements that come into play, but still, you can look at your total income and you can look at what actual tax you paid. Take the tax you paid divided by your total income on line 9, and that's your actual effective tax rate. Now, this is really important in retirement planning. The reason we want to manage these tax brackets where your next dollar is taxed is because we're trying to navigate, are you going to be in a higher tax bracket now or in a higher tax bracket in retirement? And we're going to, if you keep watching, we're going to go over an actual example where I'm going to show you how to project, how we or I project some of this out in my firm. I'm going to show you an exact example from my financial planning software. But we're projecting taxes now versus taxes later, and tax brackets are a big thing. But there's something that's out of our control that's happening soon. The tax brackets that I just explained, the 10, the 12, the 22, the 24, the 32, the 35, and the 37, those are all from 2017 Tax Cuts and Jobs Act that was implemented. Those are the new brackets from the Tax Cuts and Jobs Act. Well, the Tax Cuts and Jobs Act is sunsetting in 2025. So by something completely out of our control, besides our ability to vote, the tax brackets are going to change overnight. So as we try to predict tax brackets now and what you're going to be paying in the future, you could be in the same amount of money, the same range, but just by putting your head on your pillow on December 31st, 2025 and waking up on January 1st, 2026, your tax rate or those percentages are going to change. So the 12% is going to turn into the 15%. The 22% is going to turn into the 25. The 24% is going to turn into 28. 32 is 33. 35 will stay the same, and 37 will actually turn into 39.6. These were the rates before the Tax Cuts and Jobs Act. So it's sunsetting and reverting back. I won't go through each one of the ranges. Go download this so you can check it out yourself. But overnight, you're going to fall into a higher tax bracket unless there's some sort of government or congressional intervention, which I don't know if that's going to happen. We don't know. It's 2024, so who knows if that's going to change. But this is some of the things that we have to plan and prepare for as we look into future tax brackets and future tax rates. So let's see what that looks like in an actual tax plan or retirement plan. Okay, so I've protected these clients' information. They're in their late 60s. They have an adjusted taxable income right now of about $363,000. They have federal taxes paid of about 80,000 bucks. Their federal income tax bracket, their highest marginal tax bracket is 24%. So that means every next dollar is taxed at 24%. Their capital gains tax bracket is 15%, but because of how much income they make, there's an extra net investment income tax of 3.8%, but that's not noted here. Let's say they retired. I built this out. So let's say they retired next year at age 70. The reason for age 70 is because that's when Social Security would kick in for them both. Their adjusted taxable income would drop substantially. Their federal taxes paid would come down to their adjusted taxable income would be about $100,000. Their taxes paid would be about 26, and their federal income tax bracket would be about 22%. And if you're watching this, you can see here that from that first year, every single year their tax bracket's going higher and higher and higher. It's going from 22% to 25. You know why that is? Because that's 2026. It is already built in here to my planning software that overnight their taxes are going to go up and their income is only going to go up very little, but their taxes are going to go up substantially just because of the brackets. In this particular case, in my estimation, from 2026 to 2027, or excuse me, 2025 to 2026, their income only increases by 10,000 bucks. Their income need increases by 10,000 bucks, but their taxes go up by 4,500 because of that percentage change in what they're going to be paying by those tax brackets. And then from there with these particular clients, 25% for a couple of years and 28% and then 33% for basically the remainder of their retirement. And you want to know why that is? It's because of required minimum distributions. I can show you here that they're going to be making big withdrawals from their not only taxable accounts, but from their tax deferred accounts. They're going to start at required minimum distribution age, which is going to increase their taxes substantially. So it's somewhat out of our control on whether or not we are going to have to pay any taxes. They're going to have to. But the question becomes, does this affect anything in the future? Their probability of success in retirement is very high, regardless of the taxes paid. So this is what I talked to you about before is we'd like to reduce taxes, but not at the expense of living the life that you want and being able to spend what you want. And these people want to spend a pretty substantial amount, about 15,000 bucks a month. And they can afford it. They have a very high probability of success. We like that a lot. But you can see here in the chart, their tax brackets are going to be at 33% essentially for the remainder of their retirement. But look at it this way. Yeah, we're going to pay more in taxes. We were in a very high income state as we were earning. So we were deferring a lot of these big taxes, these big tax bills. So they're going to come due. But even when they do come due, we've planned and prepared for it. And so we can make the proper distributions regardless for you to spend the amount of money that you want along the way. Now, briefly going back to our discussion about the effective tax rate versus the marginal tax rate, you can see here with these clients, their actual effective tax rates, the amount of tax paid versus their total income is substantially less. Remember, their tax brackets in some cases are going to be 28, 28, and 33 as they earn more money and get a little bit older. So remember, their next dollars are going to be taxed at 28%, 28%, and 33%. But the actual effective tax rate in that same window of time is 18, 19, and 20%. So the next dollar is taxed higher, but the actual amount of tax paid federally, I should say, is literally a lot less. The actual amount paid compared to your total income is a lot less. And we can also project that out and figure out which situation works best. This is where people start to talk a lot about Roth conversions. Well, maybe if we take advantage of lower brackets now, let's convert some money and we'll do some future taxes later. And this could be an option for these particular individuals if we wanted to maybe spend over the next couple of years filling up some brackets. And let's see here. If a client filled up, let's say, the 22 and 25% tax brackets, this particular client, they actually end up with a little bit less by trying to do conversions now, just because the tax bills would be so big early on. So it doesn't actually make sense for these particular clients to do that. So this is why evaluating Roth conversions on an individual basis is what's so important. So going back to the probability of success, they have a very high probability of success in retirement, all because they want to have such a high income amount. These are clients that want to spend a lot more. They don't want to end up with more than they have now in retirement. They just want to make sure that they can live the life they want for as long as they want. This plan goes out to age 100, and there's a little bit left over to make sure that they can protect themselves for long-term care or any extraneous medical expenses, but I already have that built in as well. So as you focus on how much money you have left, remember in my opening here, I talked about there's a disconnect because most people don't want to watch their balances dwindle a little bit. But if the balance is dwindling and you're living the life you want, that could be okay. We just want to make sure there's enough at the end to protect you in the event of medical expenses or catastrophes at the end of life. All right, I hope you can see my screen here. The last thing I want to share is Social Security taxation. I got Robert and Roxanne retiree, again, clients, but we're modifying their names out of protection. You can see here that in some good tax planning, we can start to evaluate how much tax will be paid and what will happen to your Social Security by adding any additional income. So you can see here this couple has $45,000 of Social Security. As of right now, only $7,000 of it is taxable, and that's because of additional dividends and taxable interest that goes into the calculation of bringing in Social Security. But in this scenario, they have a total income of 31,000 bucks because of their deductions, and they actually have a taxable income of very little. And so their total tax paid is zero. So regardless of everything being brought in, even their Social Security being pulled over, they have a loss, some income from Schedule E, but they don't have to pay any taxes. But just what if they had to take a distribution from their IRA, maybe a required minimum distribution of, let's say, $50,000? That $50,000 is going to change everything. Not right here at the top, not where we're just entering in the data. Uh-oh, hang on. Let me go back to the scenario. I refreshed the screen accidentally. But if we went to $50,000 of additional income and left everything else the same, you can see that their taxable Social Security, the amount that's brought in is 85%. That's the maximum amount of Social Security that can be brought over into taxation. So you can see their income went up not only by, well, we pulled out $50,000 from our IRA, but now we pulled in $38,000 of Social Security in addition to the existing Social Security. So we look down now, and overnight we have an RMD distribution of 50,000 bucks. We have Social Security, the amount that you get, plus this amount of Social Security that is taxable to you. Those things kind of all work together in your total income situation. They get the standard deduction because they're a little bit older. Their taxable income went from $665 to $81,000. Their total tax went from 0 to 6,500 bucks because they took a distribution. This is the tax trap. Yeah, this is very dangerous when you start to pull in Social Security and all their other income sources. This is a very interesting proposition when you start to bring more money on here. I hope I explained that well enough, but bringing in more income brings more Social Security over to being taxed. So again, let me reiterate just to make sure I explain this properly and we're clear. $50,000 of an RMD comes over as new income. Your taxable interest, dividends, and total dividends are all added to that. Then you bring in 85% of your taxable Social Security. That's $38,250. That all is added to any Schedule D or any other business income for a total income amount of $111,000. minus the standard deduction makes a new taxable income of $81,000, all from a $50,000 RMD. And your tax goes up to $6,597. Taxes in retirement are very, very dynamic and fluid. One thing that you change could affect many other different items. And this probably affects Medicare surcharges, IRMA. There's a lot of stuff that could come from things like this that we need to be careful of in tax planning. So I know I went over a lot of unusual numbers. You can go watch this and see the numbers for yourself on the YouTube channel at ProPath Financial is the handle for the YouTube channel, or you can just search Thatcher Taylor on YouTube. Also, the links are below. If you go to propathfinancial.com/post/tax planning, you'll be able to see this whole write-up and any additional information that you can read through as well. You have to know that taxes are a huge component, but we want to just navigate taxes in a way that you can still live your life. I don't want you staying up at night worried about paying the tax man. If you prepare for it, if you plan for it, if you invest properly in the right places, you can navigate taxes really well in retirement, regardless of how much income you make and any changes that happen governmentally or outside of our control. Planning matters. If you have any questions, please feel free to reach out. If you have any questions specifically about your situation you'd like me to answer in this podcast, I'm happy to do it. Shoot them over to me, Thatcher at propathfinancial.com. You'll see the link below in the show notes and the comments. Thanks for listening. Thanks for watching. We'll see you next time.